Google and Amazon and Facebook are growing 20-25%. They're beating the hurdle rate.
Yeah.
The hurdle rate you have to beat is the cost of capital, is the expansion of the M2 money supply. And so they're beating it. That's working. There's a nuisance. I'm not really paying attention. What happened was 2020, when everything came to a grinding halt, and the gravy train ends, you know, like the bond train ends when interest rates get to zero. Big tech becomes a crowded trade, and in like a matter of weeks, you realize that it's now, you know, the P to E of Apple doubles, even though the revenue's flat, even though the earnings are flat. And when I was invested in something that everybody else disagreed with, when 99% of the world disagreed with it, I was confident that was going to work. And as long as there's a debate, like, you know, I'm tweeting Apple's going to take over the world and everybody's disagreeing with me and they're telling me to buy HP and IBM, then I'm comfortable. When we got to 2020, everything flipped and everybody agreed, you know, and 20-year-old Uber drivers were buying Apple and Amazon, and my niece, who was like in junior high, she's buying Apple stock when it's going up by a factor of 20.
Yeah.
And I'm like, okay, I have to get out now. This world has changed, right? And so what happened was I lost faith in the monetary currency and the monetary policy in Europe and the US this year.
Yeah.
And I lost faith in the big tech trade this year. And it's not hard, right? I mean, the M2 money supply expands by 24%. If the money supply is expanding by 2, 3, 4x what it was, at some point you notice. It's like, if I turn down the temperature by 3 degrees every year, you might not notice. But if I crank it down by 20 degrees or 25 degrees, you notice. So I would say my worldview inverted. And what I realized was, you know, all the big tech companies were now monopolies, and they were at the end of a 10-year run. And they weren't going to be a good store of value. You know, bonds to store value have to yield more than the expansion of the monetary supply if they're risk-free, right? The risk-free interest rate is the M2 monetary supply expansion if you wish to acquire scarce assets in the future with your money. And otherwise, if you're concerned about wealth preservation, your inflation rate isn't 1 or 2%. It isn't the consumer inflation rate. It's the inflation rate of a basket of scarce assets that you desire. That basket looks like it's expanding or inflating at 15, 20%, you know, and we can debate what it is. But when that happened, then I realized that bonds aren't going to hold value because their yield is not greater than that monetary supply expansion. Equities have to grow faster than the rate of monetary expansion. So maybe you can grow cash flow 6% a year, and if you're growing 20% a year, you're good. If you're growing 6% a year in the last decade, then you leverage up. So you borrow debt, you short the dollar, you buy back half your shares, and your 6% looks like 12% EPS, and then it starts to work. At the point that you can't leverage up anymore, and at the point that the hurdle rate triples, it becomes pretty clear that nearly all the bonds won't hold value. Most real estate's not going to hold value. And most equity isn't going to be a store of value either because the hurdle rate tripled. So now you have to run around looking for a scarce asset, a scarce desirable asset. And you can't buy a liquid portfolio of Picassos or Van Goghs, as far as I know, at a fair price. And in theory, liquid or scarce real estate, beachfront property that every other wealthy person wants, it might hold value, but how are you going to buy that in a liquid portfolio at a fair price? And so it leads you to look at precious metals. And the problem with precious metals is, you know, you can create derivatives, and so you can print more financially, and then you can also mine more. And then it's very difficult to verify how much there is. And so they're not a hard precious asset in the way that a crypto might be. So that leads you to crypto, and after you sort through 6,500 cryptos, the conclusion is Bitcoin is the dominant crypto asset network. and it's 50 times bigger than the next thing that looks like it. And so my conclusion became, Bitcoin is the monetary network, like Facebook was the social network, except the monetary network's worth 100 times as much as a social network. And if Facebook's worth $1 trillion, I'm the guy that bought 500,000 shares of Facebook at $12 a share before it went public. And then I bought another 400,000 shares at $38 a share. And then I watched it go to 280. So I understand Facebook, and Facebook was a phenomenon that was inconceivable before they created it. There wasn't any competitor to it. They collected and channeled social energy of 1 billion people, and then 2 billion people, and maybe 3 billion people now. And they monetized it with advertising, and it became a dominant juggernaut. Well, I look at Bitcoin and I think, what if you had Facebook for money? What if it was Facebook for billionaires? What happens when 10 billionaires put $1 billion each on the Bitcoin network? What happens when thousands of millionaires put $1 million each on the Bitcoin network? And that's worth 100 times what Facebook was. And of course, what did I need to do? I needed to conclude that it was 50 times stronger than the next best thing. And you can look at Bitcoin Cash and Bitcoin Satoshi Vision, and they're similar, but they're 50x smaller. And then I needed to work through the Ethereum thing, and my conclusion with Ethereum is it's not a treasury network because they're going to convert from proof of work to proof of stake. And until they've run $100 billion on a proof of stake network for 5 years, you can't reasonably trust it with your treasury assets. It's more like it's like a unicorn. It's something, but it's not a treasury reserve network if you want to store a value. Once I got past that and I saw Bitcoin was 200 billion, it's game over, right? But by the way, and the last icing on the cake is 99% of the world disagreeing with me.
Exactly. Contrarian investor. That's what I'm doing, what I also recommend in my books, in my consulting. You always have to bet against the mainstream, against the big mass. Do always invest contrarian. If the whole world thinks Bitcoin is it, then sell your Bitcoin. But there's one question I have, Michael, because you made a lot of money with domains, with web domains. So you already understood back in the days the scarcity of digital assets. So why didn't it click in your head when you learned about Bitcoin in 2010 or 12?
It's because if you're making, your brain has got this much bandwidth. And there's a lot of smart people in the world, right? The world's full of people that don't understand Bitcoin, but they're smart, right? They're not stupid. They're ignorant, right? They're uninformed, and they don't understand it, and they haven't taken the time to understand it. So I don't think I was stupid. I was smart enough to start a company, smart enough to buy up Hope.com and Angel.com and Alarm.com and Voice.com and Strategy and the like. And I was smart enough to make $500 million investing in FANG stocks. But if all those things are working, and if you're preoccupied by running your business and everything's working, and by the way, Apple was a pretty good idea in 2012. You could have bought Amazon at $300 a share, 2013, 2012. It was going to go up by a factor of 10. I was already in love with something else, right?
Okay.
Preoccupied. Apple was going to go up by a factor of 20. Amazon was going to go up by a factor of 15 or 20. Google and Twitter and Facebook, these were all going to go up by a factor of 20. I had my thing, and then Bitcoin was a nuisance. It was a noise. By the way, Bitcoin was at a different stage too, right? The risk reward is different. There are 100x as much risk, and there was a 10,000x as much return, right? If you had bought it, in 2013, you would have gotten a monster return, but you had to get through the fork wars. You had to get through the Mt. Gox, failure. You had to get through the question of, will the IRS legitimize it? Will the SEC legitimize it? Will the OCC legitimize it? Will Congress legitimize it? Will the Senate legitimize it? Will institutional investors legitimize it? Will the cowboy exchanges with 125x leverage blow it up? And these are all challenges to Bitcoin that it overcame between 2012 and 2020. So my view is buying it at 10,000 was a lot less risky and a lot more obvious than buying it in 2012. But maybe more to the point, I had a motive in 2020, right? I had a problem to solve. And one problem personally was the big tech trade was crowded, right? Nobody thinks that Apple and Amazon would go up by a factor of 10 or 20 from here, right? And the corporate problem was I had 500 million in cash, and it was looking like it was going to lose 15% of its purchasing power a year. And so I'm going to lose 50 to 75% of the cash value, right? And the outside shareholders didn't appreciate the cash. They literally told me, we don't give you any value for the cash. So I had a corporate problem. I had a melting ice cube liability. Personally, I became disenchanted, you know, with the world. And the world turned upside down. So now I had to reassess all my premises, and I had to open my mind. And that led me to the Bitcoin standard. And that led me to macroeconomics. And that led me to a hard assessment of the impact of monetary expansion everywhere in the world on the value of assets. And that led me to conclude that inflation is not 0%. Inflation is a vector. And the inflation rate of a market basket of scarce assets is running 15, 20%, not 1%. And if your goal is to invest so that you can purchase streaming YouTube and Netflix videos, it's not that hard. But if your goal is to invest to buy precious things that people want, i.e. wealth preservation, you're going to have to change your strategy. And so that's how I came to discover Bitcoin.